The banks won't survive this. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, we have a shocking report out of the Federal Reserve that shows the U.S. consumer is now more in debt than ever before, and that this is going to lead to a massive number of delinquencies and eventually defaults that will be so bad that I don't think the banking system will survive. Plus, we've got more evidence that shows the Federal Reserve is completely clueless when it comes to the economy, and a data series that the experts are claiming is going to lead to more inflation. But we're going to show you why the experts have this wrong. Let's over to CNBC, where we picked today's story up with a headline: Consumer debt hits record $16.9 trillion as delinquencies also rise. Now, the issue isn't the debt, because in a debt-based economy, you need to see a constant expansion of debt. The problem occurs is when you get to a point where the debt is so large and the economy slows that people can't make payments. That's where you see delinquencies begin. And when you see those start, well, you know the defaults aren't too far off in the distant future. Debt across all categories totaled $16.9 trillion, up about a whopping $1.3 trillion from a year ago. Get this, as balances rose across all major categories. Even mortgages, despite a decline in originations, mortgage balances increased $11.9 trillion, just showing that debt is broad-based across the entire economy. Mortgage loans considered in serious delinquencies of 90 days or more rose to a rate of 0.57%. This is still historically low, but nearly double where they were from a year ago. Auto loan debt delinquencies rose 0.6 percentage points to 2.2, while credit card jumped 0.8 percentage point to 4%. Now, many people ask me, Steve, do you think that we're going to see another housing crisis like we did during the great financial crisis? Well, possibly, but I think this time around where the debt bomb blows up is going to be in the credit card space and the auto loan space. I think it begins there and then eventually gets into the housing market. But now I want to take a look at this next chart and show you why we see delinquencies start to build at this point in time and why it is an ominous sign that this is just the beginning of where this delinquency wave is coming from. Here we can see total debt, credit owned and securitized in blue. This is shown on a year-over-year rate of change against delinquency rate of all loans, also shown on a year-over-year rate of change, and that in red. And notice when we see a big surge in consumer credit that the delinquency rate tends to go down. That's fairly normal. As you see in an expanding economy, you want to see debt expanding and delinquencies falling. That means the economy is working. But notice then what happens when you get to a point where the debt is really high, you start to see delinquencies roll up, and that's where you get to be a challenge for the economy. And here we can see now the rate of change in loans is very high and delinquencies are starting to tick up. So the question now is, since we see this relationship, is there something that's causing it? What is keeping the consumer from being able to pay on their loans? And the question may be, is it just a function that the economy isn't growing as fast, or is there another issue? Well, the answer is there's another issue. On this chart, we're going to take a look at total consumer credit owned, again, staying that color in blue, against the consumer price index in red. Again, both of them shown on a year-over-year rate of change. And what I want you to see here is as the debt expands in blue, you see the rate of change in debt rising, it leads to an expansion in consumer prices. You would expect to see demand for debt, demand in the economy, lead to an increase in consumer prices. And we see that happen almost every time where the debt leads consumer prices higher. So now what's happening as consumer prices get too high, what you'll notice then is the debt growth starts to roll over and head lower. And then of course that leads consumer prices down. So what we're seeing is that the problem in the economy is that prices get too high. There's not enough debt being expanded for people to afford those higher prices. The economy then naturally slows down and then tends to head down into a recession. So as we go back to the chart and see what's going on here, we have this massive expansion of debt out of the pandemic. Consumer prices took off. Now you see the debt rolling over, consumer prices heading down, and that tells us that we've got a major problem. Credit card balances grew robustly in the fourth quarter, while mortgage and auto loan balances grew at a more moderate pace, reflecting activity consistent with pre-pandemic levels. Although historically low unemployment has kept consumers' financial footing generally strong, stubbornly high prices, there you go, and climbing interest rates may be testing some borrowers' ability to repay their debts, because we have a twofold issue. One, we have the problem is that wages aren't keeping up with prices, so people have to consume less. The other factor here is in the interest rate market. As the Fed raises rates, we know with a 2-month lag, those increases hit credit card balances. So when people already maxed out on their debt and now we're seeing their minimum payment go up, that eats into their discretionary spending. So you have effectively a double whammy. You have higher prices, higher interest rates, and it all turns into less spending and a slowing economy. And now we can see that that eventually turns into the ability to repay their debt. And we see although historically low unemployment has kept them strong, the question is what changes now if we now go back to the consumer credit chart and overlay the 4-week moving average of initial claims. What we would expect to see and want to see is as debt is expanding, the amount of unemployment claims or the number of them goes down. And that would make sense because as the economy is expanding, again, it's a debt-based economy, you should expect to see more people working and fewer people making claims. But notably then, as the debt starts to roll over, as we get into the late stage of the cycle, what happens is you notice unemployment claims tend to rise. Now, there are some anomalies where you see debt expanding, but it's still not as fast as the prior rate. So the economy just can't keep up because there isn't enough debt being issued to keep the economy growing at the pace it needs to keep everybody working. And you see this happen again and again. So now we see almost the last leg here in this current cycle. The expansion of debt dropped the initial claims rate down, but as it starts to roll over and head down, what it tells us is the number of unemployed that are going to hit the on the unemployment line are going to increase. And of course, everyone's going to turn around and you can guess who they're going to blame: the Fed. The rise in balances come amid an aggressive rate hiking campaign from the Fed as it battled inflation running near its highest level in more than 41 years, although we know for a fact the Fed is unable, of course, to deal with inflation. They don't have the tools. But let's go and see if the Fed has any sort of impact on bank lending, and you might be surprised. They do, but not in the way you'd think. So here we can see the federal funds rate now shown in red against total consumer credit owned and securitized, still in blue, shown on a year-over-year rate of change. And what we can note is that as consumer credit rises, the Fed eventually raises rates, and then, of course, consumer credit comes crashing down. This, again, is a demand issue, and I don't think it has a lot to do with the Fed as much as the Fed is reacting to the economy here. And again, you see this cycle over and over again, and then the Fed eventually starts to cut. Notice that they start to cut, at least in modern times, and that causes lending to collapse. Of course, you'd think just the opposite would happen, as of course you would expect rate cuts to lead to more demand for loans. What is a sign of the economy is slowing down and the Fed is reacting to that. So the idea that the Fed is pushing the window here, I think, is a wrong view, because what will likely happen now as these delinquencies continue to mount, they will turn into defaults. And the question that everyone keeps asking, are the banks able to weather the storm? And my answer is, I don't think so. Again, watch the auto space and the credit card space as the leading indicators of where this is going. Now, many people have wondered, how does this impact the markets? And there's been a question is, how do I sign up for this report and get the coupon? Well, I'll show you. If you're wondering how to use this report, you'll notice the market is long and struggling to go higher here. The machines are already maxed out in their positioning. The market wants to go higher, but if it rolls over, you'll start to see these positions sell down. And what that's telling you is, hey, this is time to take some profits. You'll notice that this report, the CTA Timer Pro, will give it to you faster than almost anything else you've seen. Now, the question that keeps coming in is, Steve, I want to sign up for it, can't find the coupon. So here's what I've done. I've added some more coupon codes, but here's how you get it. Go to any one of my videos, including this one. Go down to the description, and here you see CTA Timer Pro. Click the link or show more. There's the link. It'll take you right to the coupon, and there's the code 10 off. You can do that. Again, I added a few more for those who missed it. Now let's talk about the Clueless Fed, as two Fed officials would have supported larger rate hike increases this month. Of course, we've heard already from Loretta Metre, we talked about yesterday, but now adding to that story, we've got another one. This time it is Bullard, as James Bullard also said Thursday he would have favored a half-point rate increase in the last meeting and that he would support moving as quickly as possible to raise rates just below 5%. I don't see much merit in delaying our approach to that level, he said. My overall judgment, it will be a long battle against inflation. Well, Mr. Bullard, I'm going to give you some reasons why that you're going to have some merit in delaying, because you've got it wrong. It is not going to be a long battle of inflation. In fact, we got some data today that shows it's not going to be much longer at all. Here we can see the export price index rose 0.8%, but the import price index, the one that matters more in terms of inflation, fell by 0.2%. Now let's quickly look at export prices. This is a function of the dollar. That's why I have the nominal broad dollar index on here. And what we can notice, periods where the dollar is rising, we can see export prices falling. So what we should expect here is as the dollar turns and is heading lower here now, what that means is export prices should at some point turn higher. Again, you can see here dollar falling, export prices rising. That makes perfect sense. But let's look at import prices, because Bullard and Metre say, hey, there's no way, we need to go higher in rates. There's no way inflation is coming down. But look at import prices in blue against the consumer price index, both on a year-over-year rate of change. What you see is import prices are heading down to the zero bound. This is this black line across. And notice the relationship here. Import prices lead consumer prices. And if you're struggling with this relationship, think about this. Those import prices are coming out of countries like China. They've got to get on boats, get to the U.S., get unloaded into warehouses, into retailers, and then into your pocket. It takes a while. That's why there's a lag here. But what I want you to see is when import prices are around the 0% bar, guess what that means for the CPI? It means it should be around 2.5%, right above the Fed's target. Again, telling us the Fed has got this all wrong. But some other people that got it wrong are the experts who are calling the producer price index yesterday to be highly inflationary. As a January PPI report shows, producer prices rose, pointing to persistent inflation. Well, Wall Street Journal, I think you got this wrong. Now, it did did fall to 6% on a year-over-year basis, and that increase in the PPI, which generally reflects supply conditions in the economy, was slower than December's 6.5% gain. It was also down markedly from the 11.7% rise going back to March of 2022. And the PPI increased 0.7% in January from the prior month. This is what got everybody excited, compared with a revised 0.2% drop in December, and significantly faster than the 0.2% average monthly rise in the year before the pandemic. So now you can see, looking at the data, everybody's going, oh wow, this is going to be inflationary. Inflation's back. It's going to send things higher. The Fed's got to hike more. This is going to be exactly what we need to see. They have more rate hikes. We need to see interest rates go up. I mean, you see all the narrative here that the market and the media is spinning. Let me show you why they've got it wrong. The PPI report is a setback in the battle against inflation. Again, more evidence that the experts have it wrong, as today's producer price index increases will translate into tomorrow's consumer-facing price hikes, which is not true at all, because the PPI does not input into the CPI. They track different data things, but then nevertheless, let's continue on, because I want to get to this chart here in a moment, because the PPI captures, I want you to understand what this does, what suppliers are charging businesses and other customers. The measure generally affects what the changes in costs that producers are facing, combined with the pricing power they command, which can signal future changes to inflationary pressures. All right, so here we go. Let's take a look at this chart now, because I'm going to show you what producer prices correlate with and why they're headed lower, not higher, and why these experts have it wrong. Here you can see producer price index in blue. We don't have a ton of data because the Fed doesn't offer us a ton of data, but notice crude oil prices in red are a leading indicator of where producer prices go, and we can see crude oil prices are at below zero on a year-over-year basis, and that tells us that producer prices are headed back to that magic number of 2.5% that we keep finding on this show, suggesting that the Fed is once again going to be facing major rate cuts later this year and not hikes, and the banks, just because the economy are slowing, are going to see a massive rise in delinquencies that are likely to lead to defaults. Will they survive? Well, I'm not sure they will, but maybe you think so. Tell us in the comments below. And with that, I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.